Senior Fund Manager at ICICI Prudential AMC, joins us now. Morning, Manish. Thank you for dropping into the studio. Well, let me start where Jayant Sinha left off. What's the general view on public sector banks itself? Moody's and Fitch at least have removed their negative and put a positive outlook. Is it buy time, or were you already buying it in the first place?
Yeah, so we've had a certain exposure to PSU banks since India's macro improved. Quite clearly, they're a big beneficiary of any improvement in the macro story. But I think there's a optionality building there also of a micro story where the government, as you've seen just now, wants to do certain reform and to make them competitive versus the private sector banks. Now there's a lot of work to do on that because the gap is very, very high, whether you talk of HR, whether you talk of technology, you talk of NPAs. So there's enormous amount of road to travel on that path in a sense. But I do think that given the valuations and the fact that you're very comfortable with India's macro right now, definitely I think it merits a place in our portfolio.
Okay, so PSU banks merit a place in the portfolio. Manish, hi, morning. The market has not given you any cheer on the whole this year. It's down about 4%. But do you expect good cheer in the last part of the year?
Well, so it's always, as I said, very difficult to time markets for 2-3 weeks. But I do think that the key variable in the short term is going to be the trajectory of the dollar, because it's a very macro-heavy period we're entering. You have ECB, you have OPEC, you have Fed. So I guess that it seems to be a truism that whenever dollar does well, the EM markets tend to suffer a bit. And we have to see how it pans out. I think December mid is the Fed meeting is, in a sense, been something where a lot of market experts have been focused on. Now, while at one level you think whatever being discussed so much would probably be a non-event, but I do think that given the amount of debt that there is in this world, given the fact that most of the trade and capital flows are linked to the dollar, I think we'll have to see how the dollar pans out. The DXY has already crossed 100. And in a sense, that generates a lot of risk of sentiment globally.
So you expect to see lower levels for our markets. Do you think we could retest those 7,500 lows that we touched recently?
Look, in a macro-heavy period, you never know how things will pan out. But I do think the markets are resilient at these levels broadly, because on a valuation basis, on a macro basis, and the domestic investors' flows seem quite resilient at this point of time. So we're not looking either for a very, very big upside in the short term, neither are we looking for a very sharp downside in the near term right now.
You know, the best bulwark against threats like these, global threats like these, is growth. If you are the only country growing, then I think that was Raghuram Rajan's answer last time when somebody asked him how would you react to the Fed rate hike. Where is the growth when is that growth coming? The auto sales numbers for December are expected to be good, better than the previous months. Do you think growth is here finally?
So, Lada, look, I mean, if you look at it in three parts, consumer, government, and private sector, I think the consumer's balance sheet is obviously very good. And you're kind of seeing that now because the anecdotal evidence we've got on consumer discretionary has been pretty okay for the festive season. So it does seem that whether you look at auto, retailing, etc., there's some pickup in demand. I think a lot of corporate growth is linked to the global scene, unfortunately. So, for example, you're seeing so much stress in exports, for example. A lot of sectors like oil and gas, metals, linked to global prices, and those are heavy drivers of capex. So, if you see pure domestic sectors, we look at roads, railways, defense, power transmission. A lot of these segments are definitely showing signs of pickup. And I guess a lot of it is courtesy the work the government has done. But there are certain things about the globe which you're pretty helpless about.
So I think you don't think earnings growth is going to be reflected in Q3 numbers in January?
I wouldn't be very gung-ho about saying that earnings growth is going to rebound very sharply. Because let's face it, I mean, if you have a lot of these big sectors like oil and gas and metals, and internally, I think the real estate is becoming a big drag for the economy. I think a lot of the cities, the transactions in real estate are not picking up, which obviously affects downstream industries like cement, steel, consumer durables to a certain extent. So when you have these headwinds, I think initially at least you will only see certain pockets grow. And maybe when the globe stabilizes or there is a bit of a pickup in global demand, that is when I think you will most likely see a very wide index-led earnings growth market.
Okay. What about the auto sector? You have a fair amount of exposure to that sector in your funds. In fact, auto at 6.5% is at a 52-week high in your ICICI Pro Balanced Advantage Fund. And now we're seeing the cycle turn a bit where there's a revival in sales. Is it still a good time to invest into the sector?
Well, I think purely both from a bottom-up and top-down perspective, this is a great sector to be because, as I said, the consumer's balance sheet is the best in the economy today. And obviously, in terms of revival, that is where you're likely to see the first piece of action. And that's kind of playing out because passenger vehicles have been one of the best segments over the last 1 year in terms of growth. From a bottom-up perspective, typically what we've seen is this sector has good balance sheets, fairly good corporate governance in terms of the industry. But having said that, I mean, the sector has been probably the only cyclical sector which has done well over last 3 years, last 5 years. So we're kind of positive on the sector, but we don't think valuations are dirt cheap right now.
So in 2016, what may you incrementally add, you think, going by the hunch and going by the trends?
I think probably the more interesting segments of the market will be a slightly deeper cyclicals like financials, capital goods, pieces of infra, logistics. Because if you see on a 3-year, 5-year basis, obviously the defensives have done very well. So a lot of stocks in FMCG, pharma and IT to us look quite expensive at this point of time.
Okay.
But having said that, as I said,
infra, logistics, you said.
Yeah, but as I said, you need to calibrate yourself with a global situation as well. So if you take a capital good company, I think anyone who has exposure to roads, defense, power transmission, etc. is doing well. But if in the portfolio you have things like oil and gas, real estate, metals, that part is obviously not doing well. So it depends on the portfolio of the company as well.
All right, Manish, we leave it at that. Thanks for your time and all the best for the quarters to come and for the next
new year
year,
ahead.
the new year ahead as well. So we'll be speaking soon, but thanks for all your